Hi, this is Steve Hutchinson with Hutchinson Family Offices, and got a good video this month. We're going to talk a little bit about the economy. We're going to discuss jobs a little bit more. We're going to talk about portfolios. We're also going to discuss the financial markets, certainly going to dive into interest rates, and then I want to give you our perspective of where we stand today. First off, let's talk about the economy. As the GDP numbers were released for the fourth quarter of 2016, we're still seeing the economy not generating any significant growth. We really need to get to the 3.5% range. I'd like to see it more in the 3.5% range. Hopefully we will see this, but that's going to come through adding more jobs, increasing wages, and improving the tax environment. And if we see those things start to take place, either out of Washington or wherever the impetus would come from, we should see some improvement in the GDP. That may not show up until sometime later in the third or fourth quarter of this year. But I would expect to see probably maybe in May or June, a nice tick up for the first quarter. We took a look at the jobs numbers. We're starting to see the jobs numbers, and we're talking about the new jobs created each month by the Bureau of Labor Statistics. The employment rate is starting to tick back down. We're seeing more labor participation rate increases. We're starting to see wages start to increase slightly. So the job market is improving. Now, how much of this is politically driven? I don't put a lot of credence in that. First off, the new administration hasn't been in office. Optimism can only drive the markets and the jobs only so much. There has to be some basis or constructive development that's occurring right now, and we haven't seen that out of Congress. Let's just be straight up. Congress hasn't accomplished very much in the first 3 months for going into the third month of this year than they did all of last year. So we'll start to see some of that change. When you take a look at portfolios, if you use this benchmark of the day after the election, we're seeing the S&P 500 up about 10%. That's not unusual. I mean, it's a nice move, but you got to look back and see that the financial markets didn't really perform very well. Year over year, we're seeing solid moves, but the big issue is that we're starting to see much stronger earnings out of the companies. Now, as we move into April, we're going to be watching those earnings very, very closely. And of course, you know, the adage sell in May and go away comes to fruition. When we talk about our portfolios, there's some of our focus list companies, Apple Computer, Google, Berkshire Hathaway. These are companies that we're going to continue to maintain positions in. When I look at the overall financial markets, they're not being swayed very much by interest rates. We have seen the 10-year rate pretty much stay the same or actually go down. So at this particular point, the big risk in the market seems to be on the commodity side, primarily in oil prices. And we'll see how that shakes out here in the next few months. Now let's talk about interest rates. At the time of this, we were expecting, this video is being done on March 13th, Monday, March 13th. We expect fully the Federal Reserve will announce a quarter point increase in the Fed funds rate, or the rate that banks lend money to each other. The markets have already factored that in. I wouldn't expect too much from the financial markets. We may get some volatility in the short run, but most people are kind of figuring that the Federal Reserve is going to increase rates 4, maybe even 5 times this year, depending on their interpretation of the economy, primarily in the labor market and in wages. But there again, remember, we've been at zero for so long. We've been at zero since 2008, 2009, and getting back to a normal Fed relationship in the markets would be very positive for the financial institutions, and we've allocated accordingly. We've increased our exposure to companies like Citibank, JP Morgan, Capital One, and of course we've added some ETFs that have some financial exposure there as well. So we're well positioned to take advantage of what we see coming down the road. Our perspective of the economy is that we're still continuing to be weak. Job growth is good, but we've got to see this job growth translate into higher wages. Higher wages means more consumer spending, more demand for goods and services. So we don't believe that we're even well into the first leg of what we would expect the economy to really do under a new administration. To go one step further, one of our most significant concerns is that the markets are becoming politicized. In other words, we're hearing this is the Trump rally. Well, that's a really bad thing to think about if you think about it, because very seldom do political influences have that much impact on the stock market over the long term. So if the market was to pull back 10%, would it be the Trump crash? I mean, it just doesn't make a lot of sense to use that analogy. We still believe that we're long in the tooth in this bull market, although valuations are relatively low. When we look at the forward PE of the S&P 500, and particularly the stocks that we have in our portfolios, we see the forward PE is running around 18. We could see that go up to as high as 22 or 23. And what does that equate to? That's a positive move of maybe another 10% or so. We're going to have some volatility as the market digests interest rates, as it tries to figure out which way Congress is going to go on taxes. So we have to be prepared for that volatility. But overall, the companies that are on our conviction list are the companies that we're willing to stay with. Now, that's it for this month's video. We'd love to answer any questions that you might have. Please feel free to give us a call. And thank you and have a great day.